So, brief breakdown on CAIE and CAIQ. The Autocallable ETFs, they're paying in excess of double-digit returns, and they've gone up in share price a little bit too. Relative to the market to a certain extent, not as much as that naturally as the indexes they represent. Basically, Autocallable, you think bond market like a bond instrument, which guarantees if you haven't fallen below, like for example, CAIE, what it denotes here, if you haven't fallen more than 40% of the market by expiration of the autocallable bond, you're going to be replenished at expiration at face value. Now, it's going to work differently with the ETF, and people seem to miss that. Change traded funds will move, and these funds have moved relative to the market intraday and over the course of weeks. So you'll see drops in them just on the way the market trades, because they're instruments that trade like equities. So you're going to get these drops, single day drops and stuff like that. But basically, you're likely not going to get as severe a drop as the index. If the index dropped, let's say 20%, there's the likelihood you're probably not going to drop as severely, just for the nature of these autocallables, how they're basically guaranteed as a bond anyway, as an autocallable bond. If you're not sustaining beyond a 40% drop, like in the case of CAIE, or a 30% drop as in the case of CAIQ, then you're going to be reimbursed at face value at expiration, along with all the interest you've already received. So I think they're pretty interesting. I think I'd be more prone to invest in CAIE and not CAIQ, because CAIQ, being NASDAQ related, only having that downside barrier of 30%, well, far less protection on a more volatile instrument being NASDAQ related, whereas CAIE is S&P 500 related, and you got 40% downside protection to a certain extent. But like I said, don't think you're going to get face value just because it hasn't dropped 40%. These ETFs are laddering into these instruments, so they have different expirations, so you get protection in that regard. But you're not going to get face value, net asset value, if you decide to trade out of it. You're going to get whatever the market price is, because they're packaging an exchange traded fund, and that's what people seem to be forgetting. They're now equity, trading on autocallable bonds that they're swapping with, for example, J.P. Morgan, companies like that. So anyway, looking at CAIE, this is S&P 500 one. It's grown its assets under management exponentially. It's up almost over half a billion in assets under management currently, which is pretty outstanding. Looking at the 52-week low, you got $25. 52-week high at $27.74. Current price around $27. So if you could get this at a discount, in my opinion, not financial advice, but I'm going to start buying it. And it's starting to get somewhat optional. There's not a ton of open interest. Bid and ask has got a gap, but you got some optionality on this, at least out to the the March 20th expiration. I saw a few contracts on there, some trades happening. So if you wanted to get in at a discount, you could always sell puts on it, or at least attempt to sell puts. But I'd advise, if you were going to do it, to use limit orders, because that bid and ask sucks. You got a bid of 40 and an ask of 80, so set it toward a higher limit on the ask, basically. CAIQ, assets under management at 39 million, so not as much growth, because you don't have as much downside protection on the autocallable as you do with the S&P 500 one, CAIE, and it's not yet optional either. So in my opinion, the one I'm going with is CAIE. It pays less on the interest, what you get on it. CAIQ is currently paying 18%. The yield on CAIE is 14 to 15%. And there's been some share price appreciation too. So these funds have returned pretty decently over the course of a year. We can compare them side by side, I guess. Let's see if we can pull CAIE up, bring a comparison on this to CAIQ. bring that up, and we can see what they're doing now. They came out around June. I know that CAIE came out around June, so we can only go back just a few months to get a decent comparison. You look at CIAQ, and you can't really compare it because it's shorter duration when it came out. But if we were going to take off CIAQ, we could see what this did for the year, basically. Total return, you go year to date. You have to go 6 months because it came out in June. So in the last 6 months, it's up over 12% on total return. So it's done pretty decently. I compare this against a S&P 500 income ETF like SPY-I, and we'll see what it's done in the last 6 month time period. And you can see it's outpacing SPY-I in the previous 6 month period. It's up 2%, almost 2% more than what SPY-I has done. So it's got a place in my portfolio. It's an interesting instrument. It's growing in popularity. Assets under management are growing. It's getting some liquidity. So I'm interested in this fund. I want to expect that price action is necessarily going to be flat or redeem you at NAV based on the auto-callable feature, because they ladder in those auto-callables, so they have different expiration dates. So basically, I would just like buy it at a discount whenever you can. That's how I'm approaching it. Once again, this isn't financial advice, but I like the instrument. It's performed really well since inception. It's growing in the assets under management. It's getting liquidity. It has a different strategy somewhat than everything else in the market. And so I think it has a place in a watch list at a minimum. All right, guys, take care. Bye.